Everything you have ever been taught about debt is wrong. Since childhood, you were told the same thing. Debt is bad. Pay off your credit cards. Avoid loans. Live within your means. And while you followed that advice religiously, the wealthiest people on earth were doing the exact opposite. They were borrowing billions of dollars, deliberately, strategically, and getting richer with every dollar they borrowed. This is not a coincidence. This is not a loophole. This is the single most powerful wealth strategy the ultra-rich have been using for centuries, that almost nobody in the middle class ever gets taught. Today, Wealth Vault is breaking it all down. This is how the rich use debt to get richer, while everyone else gets poorer. Before we go any further, we need to destroy a myth. Not all debt is the same. There are two completely different types of debt, and confusing them is one of the most expensive financial mistakes a person can make. The first type is consumer debt. This is the debt most people know. Credit card balances, car loans, buy now, pay later purchases, vacations charged to a card, clothes, gadgets, and dinners you are still paying for 6 months later. Consumer debt is toxic. It takes money out of your pocket every single month in the form of interest payments and gives you nothing in return except a depreciating asset or a fading memory. The second type is leverage debt. This is what the ultra-wealthy use. Leverage debt is borrowed money deployed into assets that generate returns higher than the interest rate on the loan itself. The rich do not borrow money to consume. They borrow money to invest. And that single distinction is responsible for more wealth inequality than almost any other factor in modern economics. Consumer debt makes banks rich. Leverage debt makes you rich. Here is something that will completely reframe how you see the ultra-wealthy. The richest people in America pay themselves almost no salary. Instead, they hold assets. Stocks, real estate, business equity, assets that grow in value over time without being taxed until they are sold. But they still need cash to live, to buy things, to fund new investments. So what do? They borrow against their assets. This strategy is called buy, borrow, die, and it is completely legal. Here is how it works. A billionaire owns $1 billion in stock. Instead of selling the stock and triggering a capital gains tax bill of hundreds of millions of dollars, they walk into a bank and use the stock as collateral for a loan. The bank lends them tens or hundreds of millions of dollars at an interest rate of 2 to 4%. The billionaire gets the cash they need. Their stock stays intact and keeps growing. And they pay back the loan with future borrowing or eventually through their estate after death, where special tax rules often reduce the bill dramatically. Elon Musk reportedly borrowed billions against his Tesla shares to fund personal expenditures and other investments without ever selling a single share. Larry Ellison of Oracle borrowed billions against his company stock. Jeff Bezos used similar strategies throughout his career. They are not spending their money. They are spending the bank's money, and their own wealth keeps compounding untouched. If you want to understand how the wealthy view debt, study real estate investors. When a billionaire buys a $100 million commercial property, they rarely pay cash. They put down $20 to $30 million of their own money and borrow the remaining $70 to $80 million from a bank. Now here is where the mathematics become extraordinary. That property generates rental income, enough to cover the mortgage payment, the property management fees, the maintenance costs, and still produce a positive cash flow. The tenants are literally paying off the loan. Meanwhile, the property appreciates in value over time. When they sell it for $150 million, the gain is calculated on the full $100 million value. But they only invested 20 to 30 million of their own money. That is leverage. Using borrowed money to multiply the return on your own capital. Donald Bren built a real estate empire worth tens of billions using exactly this strategy across decades. Sam Zell, once called the grave dancer of real estate, built a multi-billion-dollar portfolio by identifying distressed properties and using maximum leverage to acquire them. The wealthy do not fear real estate debt. They engineer it. They calculate the exact amount of leverage that maximizes returns while managing risk. And then they let their tenants make them billionaires. The most aggressive use of leverage in the billionaire playbook is using debt to acquire and grow businesses. Private equity firms, many of which are owned by billionaires, use a strategy called a leveraged buyout. They identify a profitable business, acquire it using mostly borrowed money, improve its operations and cash flow, and then sell it years later at a massive profit. The brilliance of this strategy is that the business itself often generates enough cash to repay the debt used to buy it. The private equity firm invests relatively little of their own capital, uses maximum leverage, and captures the majority of the profit when they eventually exit. Stephen Schwarzman of Blackstone has built one of the most powerful private equity empires in history using this exact model. Apollo Global Management, KKR, Carlyle Group. All built on the systematic use of leverage to amplify returns on business acquisitions. These are not gamblers. They are financial engineers who understand that when the cost of borrowing is lower than the return on investment, debt is not a liability. It is a wealth multiplier. Here is the uncomfortable question. If using debt strategically is such a powerful wealth-building tool, why does nobody teach this in school? Why are ordinary people taught that all debt is bad, while the ultra-wealthy are using debt to build billion-dollar empires? The answer is not a conspiracy, but it is worth understanding. The financial system benefits enormously from consumer debt. When ordinary people carry high-interest credit card balances, when they take out expensive personal loans, when they finance depreciating assets like cars, the banks and financial institutions that lend them that money earn extraordinary profits. In 2023 alone, American consumers paid over $130 billion in credit card interest. That is $130 billion flowing from ordinary people to financial institutions every single year. The financial education most people receive teaches them to be consumers of debt rather than engineers of it. And that distinction produces a financial outcome that compounds over an entire lifetime. The wealthy borrow to build assets. Everyone else borrows to buy things that lose value. Now here is the part that actually matters. You do not need a billion-dollar stock portfolio to start applying the principles of leverage to your own financial life. The first step is understanding the difference between good debt and bad debt in your own situation. Consumer debt on depreciating assets and lifestyle purchases costs you money every month. Strategic debt on income-producing assets can make you money every month. The second step is studying real estate investing as a starting point. A rental property financed with a mortgage where the rental income covers or exceeds all costs is a basic application of leverage that ordinary people can access. The third step is understanding business leverage. Using a business loan to fund growth, equipment, or inventory that generates returns higher than the interest rate is leverage working in your favor. The fourth and most important step is changing your fundamental relationship with debt. Stop seeing all debt as the enemy. Start evaluating each financial decision by a simple question. Is this debt going to make me money or cost me money? The wealthy have been asking that question for generations, and the answer to that question is one of the clearest lines between the financial outcomes of the ultra-rich and everyone else. So there you have it. The rich do not avoid debt. They master it. They deploy it surgically against assets that generate returns, multiply their wealth through leverage, and use the banking system to their advantage, while most people use it to their detriment. Consumer debt makes you poor. Strategic leverage makes you wealthy. And the difference between those two outcomes is simply education. Now here's the question I want to leave you with. After watching this video, has your view of debt completely changed? Or do you still think all debt is dangerous no matter what? Drop your honest answer in the comments below. This topic always sparks the best debates. Subscribe to Wealth Vault for weekly wealth secrets that the ultra-rich understand and most people never get taught. See you in the next one.